In this video, I'll be explaining the investment strategies that will help you transition from a beginner with limited funds to a millionaire. My goal is to demonstrate that financial freedom is achievable and that anyone can follow a similar path if they're determined. Let me start by asking you a simple question. Would you like to build wealth and experience the freedom that financial security provides? Most people do. This is exactly why so many quick-fix schemes exist. People often think that wealth will solve all their problems, and they hope for a sudden windfall to change their lives. But does that seem too good to be true? If so, go ahead and hit the like button and subscribe to the channel. This video aims to debunk the myth of easy fixes. The truth is that without a solid investment strategy and the right mindset, even the most significant wealth can vanish just as fast as it came. What's really required is a well-thought-out investment plan, one that's consistent and focused. Building wealth is a gradual process that requires patience. The key is to make smart decisions and stay committed to long-term investments like real estate or index funds that can provide solid returns when managed properly. When I first started investing, I didn't have much to work with. I even had dreams of becoming a race car driver, but my finances didn't allow for it. However, as I began to grow my investments, I started to make enough money to pursue things I had only dreamed of, like entering racing competitions and winning awards. Additionally, my investments gave me the opportunity to explore other passions. The world of investing can feel overwhelming because there are so many options out there, and it's easy to get distracted by the latest trends. But the real secret to success is to stay focused and not get sidetracked by passing fads. You can't master every investment strategy, and constantly shifting strategies can lead to poor financial decisions. While experimenting is part of the journey, the most important thing is to stick with stable, reliable investments that you fully understand. The key to success has been keeping my main investments consistent and only venturing into new opportunities when I feel confident about them. The first step to building wealth is increasing your disposable income. After all, you need money to invest, and the more you can earn, especially in your 20s and 30s, the better. Don't rely solely on the income from a typical 9-to-5 job. Investing and business go hand in hand. The more you learn, the more you can earn, and the more you'll be able to invest. But just because your income increases doesn't mean your spending should go up too. Managing your lifestyle is just as important as increasing your income. Take, for example, a famous musician who has made millions but still enjoys a modest lifestyle. He finds happiness in simple pleasures like spending time at home or going for a walk. The takeaway here is that when your income grows, don't start overspending. Instead, put that extra money towards savings and investments. One of the first things I suggest is paying off high-interest debt, like credit cards. This kind of debt can be a major financial burden, and paying it off can not only improve your credit score, but also make you eligible for better loans in the future. Once your debts are cleared, it's time to build an emergency savings fund, or what I like to call a freedom fund. This should cover 3 to 5 months of living expenses, which will give you peace of mind in case of unexpected setbacks such as job loss or financial emergencies. Now that you've tackled your debts and set up your savings, it's time to think about investments. Start with lower risk options, such as index funds. These funds invest your money across a range of companies, helping to minimize risk. For example, by putting money into an index fund, you gain exposure to many large, stable companies. If one company struggles, others may help offset those losses. While mutual funds may seem like an attractive choice, they often come with higher fees. These funds are actively managed in an attempt to beat the market, but I prefer low-fee index funds, which typically offer better returns in the long run. As you get older, you may want to diversify your portfolio by considering bonds, which are generally safer investments. I recommend leaning towards real estate because it's a tangible asset you can directly interact with. There are two types of investors: capital gains investors, who buy low and sell high, and cash flow investors, who focus on properties where rental income covers the mortgage. I fall into the second category, preferring investments that generate consistent cash flow. Individual stocks can be volatile, but they can also be highly profitable if you know what you're doing. There are two types of analysis when evaluating stocks. Quantitative analysis, which involves reviewing a company's financials, and qualitative analysis, which looks at the company's overall potential. Combining these two methods helps me make smarter investment decisions. It's important to understand exactly what you're investing in. Avoid making decisions based on rumors or hearsay. Diversification is also key to minimizing risk and protecting your investments from market fluctuations. Networking and continuous self-improvement can also help you secure better investment opportunities. By expanding your network and skills, you can find better deals and even gain access to free shares, which is a great way to build wealth with little initial investment. The bottom line is take the time to learn, network, and stay focused on solid investment strategies. As you grow, the opportunities will follow. Keep learning, stay disciplined, and take action. You've got this. If this video was helpful, make sure to like and subscribe for more content.